Hey YouTube, I'm Jimmy. In this video, we're going to walk through my analysis of Johnson & Johnson, ticker symbol JNJ. This video continues our series where we're analyzing all 30 stocks in the Dow Jones Industrial Average with the ultimate goal of taking that analysis and trying to build three different portfolios: a value portfolio, a growth portfolio, and a dividend portfolio. This is the 16th video in that series. You can see a link in the description below to all of the other 15 videos. Okay, now let's break down Johnson & Johnson's business. So as I'm sure you know, Johnson & Johnson makes a ton of different products. But in 2017, it surprised me to learn that their consumer products division only accounted for about 18% of revenue. Then we can see that their second largest segment is medical devices and diagnostics. And then finally, their largest segment is pharmaceuticals, which accounts for about 47% of revenue. Now, when we look at historical revenue by segment, we can see that pharmaceuticals has gradually increased its dominance over the other two categories. And we can see that revenue from consumer products has gradually declined over the past few years. They're the gray bars. And medical devices dipped lower from 2013 to about 2015, and it looks like they're starting to head higher again. So I thought that this was interesting, and maybe it's just because I haven't researched Johnson & Johnson in a while, so it surprised me. And when I first set out to start the research, I was thinking consumer products, consumer staples, something reliable, a defensive play. But now I realize that they're much more of a pharmaceutical company than I originally expected. That being said, it looks like competitors for them would be closer to companies like Pfizer and Merck. The main difference is that companies like Pfizer and Merck have about 90% of their revenue from pharmaceuticals, while we can see that Johnson & Johnson only has about 50%. Now this makes J&J more of a diversified pharmaceutical company, which I think is a good thing. But this brings us to some of the risks, some recent developments, and then after that we'll dive into the valuation of J&J stock. Okay, so currently J&J is in litigation with more than 10,000 personal injury lawsuits over claims that one of their pharmaceutical drugs causes ovarian cancer. Although lawsuits filed total more than, it's like $100 billion, many analysts believe that J&J is going to settle many of those suits and they're going to end up paying somewhere near, let's say, $10 billion, maybe less. Now, this isn't necessarily crazy news since pharmaceutical companies are always getting sued, and I understand that many people don't like the morality or lack of morality of pharmaceutical companies. And that being said, with this video, I'm trying to focus on how investable the business is from a numbers perspective. And for those of us who don't like pharmaceutical companies, I completely understand. Okay, going back to the analysis. Now, as far as the numbers go, there was also recently a court filing that Johnson & Johnson wasn't going to be able to block the generic version of Zytiga. I'm not sure how to pronounce it. This doesn't necessarily hurt earnings, but hurt expectations of earnings, because many analysts already projected a dip in revenue from $3.4 billion in 2018 to $2.3 billion in 2019. Okay, now let's see how overall revenue is done. Here's a chart of revenue going back to 2010, and as you can see, revenue pulled back in 2015 and then began moving higher again. When we throw in expectations, we can see that revenue is expected to continue to climb higher over the next few years. When we switch to net income, we can see that the story looks somewhat similar. A pullback in 2014 and 2015, started moving higher again, pulled back last year, projections have it moving higher in the future. Now, if we look at their US GAAP financials, you may see that 2017 profit, there was a huge drop in profit. The reason for this was that the new tax bill had changes in it that left J&J on the hook for tons of taxes in 2017. That's how you get adjusted earnings that look like this, and then US GAAP earnings that look like that. I think that analysts did the right thing in making these adjustments because taxes going forward are expected to go back in line with what they were. That being said, had the expectations for taxes been that they would remain high, it would only make sense to do the adjustment according to what expectations were going forward. That being said, I'm okay with the adjusted earnings. Now, one of the good parts for Johnson & Johnson investors is their dividend. This is a chart of their annual dividends going back to 2011. And as you can see, dividends have been quite consistent with a current yield of about 2.5%. Compare that to the S&P 500 and they have a dividend yield of just short of 2%. So J&J looks pretty good. Now, one of the questions I usually have when I see a very consistent dividend like this is, can they keep it up? And one of the ways you could tell is by looking at net income relative to dividends. You can use something called the dividend coverage ratio, which looks at net income, you divide that by the dividend payment, and if the result is over 1, then the company has more than 100% of net income needed to make the dividend payments. The higher that number, the better. The inverse of that is called the dividend payout ratio, which looks at how much of a dividend was paid compared to net income. So dividend divided by net income. This is a dividend payout ratio for Johnson & Johnson going back to 2008. And as we can see, they've paid out about 50% or so of net income over the past decade. Now, this is excluding the 687 or so percent that was paid out in 2007 because of the tax hit. Okay, so now we know that they pay out about half of their profits as dividends. Okay, so my next question is, now we know that they're consistently paying out dividends and they're consistently increasing them. The question is, how much are those dividends increasing by? And we want to know this because if they stick with a 50% dividend payout ratio, well, profits have to increase by about the same rate in order for dividends to continue to increase at that rate. Now this chart, this is the dividend increases from year to year. And we can see that last year, their increase was their lowest at about 5.4%. If we exclude that, the average of all the other years is about 7% a year. So that tells us that net income needs to increase by about 7% over the long run in order for dividends to continue to increase at a 7% rate, assuming that they stick with their 50% payout. Now, interestingly, this is a chart of their net income percentage gains from year to year. And as you may have expected from the net income chart that we saw before, there's been some volatility here. And this chart uses adjusted numbers. And if we had used the GAAP numbers, then 2017 there would have been an enormous drop off and then an enormous enormous gain in 2018. So I elected just to use adjusted numbers. Now, if we take this entire time period into account, including 2017 and the projections, well, the average is the very same 7%. That tells me that they can continue to pay that distribution, increasing it by about 7% a year. Now, personally, I believe that using estimates in this scenario makes a lot of sense because we want a longer time period. We could either go back, let's say, another decade that we have a longer time period because we know that there is some volatility to net income for Johnson & Johnson. But the other reason why I'm okay with using projections is because it's not like some companies have a rule that they will pay out exactly 50%, and instead of increasing by about 7%, they increase by the exact same amount every year. If that were the case, then I would want much harder, faster rules about how we're analyzing it. But in our case, they're using about 50%, profits are going up by about 7%, dividends are going up by about 7%. So I'm going to say that I seem fairly confident. I personally am fairly confident with their ability to keep doing this. This also gives us an important piece of information because if we were to buy into this company and we were to analyze what they do over the next, let's say, 5 years, and we analyze their net profit margins, not net profit margins, if we analyze how much they're increasing net profit by each year, well, if the number drops from 7% to, let's say, 5 or 3 or whatever the number might be, well, we know either they're going to have to increase what percentage of dividends they're paying out, or they're going to have to, decelerate the amount that they can increase dividends by. That's important information to have. So now the question for me is, what do we think Johnson & Johnson's stock is worth? And once again, with this type of blue chip company, I really like using discounted cash flow. So if we take free cash flow going out the next few years and we discount it by our weighted average cost of capital of about 8.5%, we use a perpetual growth rate of 2.5%, we end up with a fair value of about $169 per share. Now, if you're wondering how we calculated this, we have videos from many of the components of how to calculate discounted cash flow. The most common question that people ask me is how you come up with weighted average cost of capital. And we have a video on breaking down that exact thing. Here's the calculation that we ultimately used for WACC. And to get the cost of equity, what we did is we used what is known as the capital asset pricing model. You can see a link to all these videos in the description below. And if you're ever wondering if the weighted average cost of capital that you're using is a reasonable number to use, well, you can always go back to different periods of time in the past and try to calculate WACC for that time period. This chart here, this is a chart of WACC going back to the end of 2007. And as we could see, 8% or so seems to be about the average. We used 8.5%, which is a bit more conservative. Had we used 8%, well, our fair value would have jumped to about $185 per share. And for me, this speaks to the importance of trying to use more conservative numbers when coming up with the fair value. So once we realize that the current price is about $145 a share, well, if we were a bit less disciplined, then perhaps we could adjust our WACC to try to make it look like a better buy. Or if we don't want to buy it, perhaps we could adjust our WACC to make it look like a worse buy. Either way, knowing that the current price is $145, our fair value estimate is $169, we get to decide if we believe that gap, that potential upside, is justified by the risk we would be taking in investing in this company. So what do you think? Does Johnson & Johnson deserve to be in any of our ideal portfolios? From a dividend perspective, they seem quite good. We saw that. From a growth, they seem okay. We saw the 7% numbers. That seems reasonable. From a value perspective, there seems to be some upside. Personally, I'd like it if they fell a bit more. That would make it a bit more interesting. Perhaps we get lucky and before we go ahead and build our portfolios, the stock falls off. That would make it more interesting when it comes time to actually build the portfolios. My question to you is, do you think that Johnson & Johnson stock is worth buying right here? Let me know what you think in the comments below. And if you haven't done so already, don't forget to hit the subscribe button. And thanks for sticking with me all the way to the end of the video. And I'll see you in the next video. Thanks.